Why trade options instead of stocks? Trading options instead of stocks offers several strategic advantages that appeal to both experienced and beginner traders seeking flexibility, leverage, and risk management tools. Here are 5 key reasons why some traders prefer options over stocks. 1. Leverage for higher potential returns. Leverage is one of the most compelling reasons traders choose options over stocks, as it allows them to control a larger position in an underlying asset with significantly less capital. In an options trade, traders can enter positions on stocks for a fraction of the cost compared to purchasing the stock outright. This leverage comes from the ability to control 100 shares of the underlying stock with just one options contract. For example, a trader buying a call option for a stock that costs $100 might pay a premium of $5 per share, totaling $500 for one contract. This contrasts with purchasing 100 shares of the stock, which would cost $10,000. The potential for amplified returns in options is clear. If the price of the underlying stock rises significantly, the price of the call option may increase at a much higher percentage rate than the stock itself. For instance, if the stock rises by 10%, the call option might see a return of 30%, 50%, or even higher, depending on the volatility and time left to expiration. This leverage allows traders to maximize profits without needing a large upfront investment. However, this potential for higher returns comes with an inherent risk. Options can expire worthless, and traders could lose the entire premium paid for the contract if the stock does not move in the anticipated direction. This risk is a key consideration for options traders, who must carefully monitor time decay and volatility to manage their positions effectively. In contrast, stock traders don't face the risk of expiration, but they are still exposed to downside risk if the stock price drops. 2. Flexibility in strategies. Options trading offers unparalleled flexibility when it comes to strategies, enabling traders to adjust their approach to suit different market conditions. Options are not just tools for speculation. They also serve as versatile instruments for risk management. Traders can employ a wide variety of strategies depending on their outlook on the underlying asset. For example, if a trader is bullish on a stock, they can buy a call option, which gives them the right to buy the stock at a set price. Conversely, if they are bearish, they can buy a put option, which gives them the right to sell the stock at a predetermined price. For those anticipating little price movement, strategies like straddles and strangles come into play. In a straddle, a trader buys both a call and a put option on the same stock, betting that volatility will cause significant movement in either direction. This strategy benefits from large price swings, whether the stock moves up or down. A strangle is a similar strategy but involves buying out-of-the-money call and put options, which typically requires a smaller upfront investment but also needs a larger price move to become profitable. Additionally, options enable more advanced strategies, such as covered calls, where an investor holds a long position in a stock and sells a call option on that stock to generate additional income. Iron condors and butterflies are more complex strategies that involve selling and buying different options at varying strike prices, designed to profit from stable or predictable price movements. These strategies enable traders to adjust their positions based on their market outlook, whether they expect high volatility, low volatility, or directional moves in the underlying asset. In contrast, stock trading is more straightforward. Investors can only buy, sell, or short the stock itself. While stocks offer flexibility in terms of long and short positions, they do not provide the same range of tactical choices as options, making options a powerful tool for traders looking to capitalize on different market conditions or hedge existing positions effectively. 3. Defined risk in options trading. One of the most significant advantages of trading options is the ability to define and limit risk upfront. When a trader buys an options contract, their maximum loss is capped at the premium paid for that contract. This contrasts sharply with trading stocks, where the potential for loss is theoretically unlimited if the stock price declines to zero. For example, if a trader purchases a call option for $5 per share and the stock price fails to rise, the most they can lose is the $5 per share premium they paid, regardless of how much the underlying stock price falls. In contrast, if a stockholder buys shares of a stock at $50 per share and the stock price falls to $0, their loss is the full $50 per share. The defined risk feature makes options an attractive choice for risk-conscious traders who want to limit their exposure to specific amounts. This feature is particularly important in volatile markets or when traders want to take positions on highly speculative assets. Moreover, since the risk is known and fixed at the time of the trade, it allows for more predictable risk management strategies. A trader can calculate potential returns and losses based on different price movements and expiration dates, giving them the ability to make well-informed decisions. Additionally, some option strategies can even reduce or eliminate risk. For example, a protective put strategy involves buying a put option for a stock already owned. This acts as a form of insurance, ensuring that if the stock price falls below the strike price, the trader has the right to sell the stock at that price, thus capping the downside risk. Such strategies are not available in stock trading, where the only risk management option is to sell the shares, often at a loss, if the price drops significantly. 4. Profit in multiple market conditions. Options offer the flexibility to profit in various market conditions, whether the market is trending up, down, or even staying flat. This versatility stems from the numerous strategies available to options traders. For example, if a trader expects a stock to rise, they can buy a call option to benefit from the upward movement. However, if they expect a decline, they can purchase a put option to profit from the drop. In both cases, the trader is speculating on price movement, but each strategy is tailored to a different direction. In contrast, stock trading is generally confined to directional bets, either buying shares in anticipation of a rise or shorting stocks in anticipation of a decline. While stock traders can technically profit from flat or sideways markets by engaging in short selling, it requires borrowing shares, and the process is generally more complex and restricted compared to the variety of option strategies available. 5. Hedging and risk management. Options serve as powerful tools for hedging, allowing traders to protect their investments against adverse price movements. One of the primary reasons traders use options is to mitigate risk in other parts of their portfolios. The most common hedging strategy is purchasing put options as protection against potential losses in long stock positions. If the price of the underlying stock declines, the put option increases in value, offsetting the losses in the stock itself. This strategy is often referred to as a protective put or a married put. For example, if an investor holds a significant position in a particular stock, they can purchase put options to ensure that if the stock price drops sharply, they can still sell the stock at a predetermined strike price. This strategy allows investors to continue holding the stock for potential upside, while having a safety net in place should the market move against them. Additionally, options can be used to hedge against other risks, such as interest rate changes, currency fluctuations, or commodity price shifts. A covered call, for instance, is another hedging strategy where an investor sells call options against a stock they already own. By doing so, the investor collects premium income, which can help offset the potential downside risk if the stock price drops, though it caps the potential for gains if the stock rises significantly. Options trading offers advantages such as leverage, flexibility, defined risk, multi-directional profit potential, and hedging capabilities. While stocks remain a straightforward and reliable investment, options provide additional tools for managing risk and pursuing diverse strategies. Traders must, however, understand the complexity and risks associated with options before diving into this dynamic market.